And the death of Borders, how a bookstore giant fed its own demise. Picture this. It's 2001, and you're the CEO of one of America's largest bookstore chains. The internet is exploding, everyone's talking about this thing called e-commerce, and your biggest competitor just launched something called Amazon.com. What do? If you're Borders Group, you make possibly the worst strategic decision in retail history. You literally hand over your entire online presence to your competitor and pay them for the privilege. This isn't just corporate incompetence, this is corporate suicide with a smile. For 10 years, Borders essentially trained their customers to shop at Amazon, built Amazon's book recommendation algorithms with their own customer data, and wondered why people stopped walking into their stores. By the time they realized their mistake, Amazon had grown from a scrappy startup into a retail behemoth, fed partially by Borders' own customers. This is the story of how Borders bookstores didn't just fail to adapt to the digital age, they actively accelerated their own extinction by literally outsourcing their future to their biggest competitor. Borders started as the American dream success story back in 1971 when brothers Tom and Louis Borders opened their first store in Ann Arbor, Michigan. These weren't just bookstore owners, they were genuine innovators. Tom Borders had a mathematics background and created one of the first computerized inventory systems for bookstores, allowing them to track which titles were selling and automatically reorder popular books. This was revolutionary stuff in the 70s, when most bookstores still relied on gut feelings and handwritten ledgers. Their system was so advanced that other bookstores would literally send employees to spy on Borders' shelves to figure out what books they should be carrying. By 1985, they had grown to 4 stores and caught the attention of Kmart Corporation, who bought the chain and began aggressive expansion. Under Kmart's ownership, Borders exploded across America, opening massive superstores that averaged 30,000 square feet and carried over 200,000 titles. These weren't just bookstores, they were cultural destinations with cafes, reading areas, and regular author events. By the late 90s, Borders had grown to over 400 stores and was generating over $3 billion in annual revenue. But while Borders was busy building physical temples to books, a former Wall Street hedge fund analyst named Jeff Bezos was working out of his garage in Bellevue, Washington, shipping books in padded envelopes. Amazon launched in July 1995 with a simple premise: sell books online with a vastly larger selection than any physical store could ever offer. Borders management looked at this upstart internet company and made a catastrophic miscalculation. They saw Amazon as a minor annoyance, not an existential threat. After all, how could a website compete with the sensory experience of browsing physical books, the smell of coffee, the comfortable reading chairs, and the knowledgeable staff recommendations? Borders executives believed that books were different from other retail products, that customers would always want to physically handle books before buying them. They were so confident in this belief that when the internet boom began, they made virtually no investment in developing their own e-commerce capabilities. Instead, they doubled down on physical expansion, continuing to open new superstores even as early warning signs suggested that consumer behavior was beginning to shift. The partnership that would ultimately destroy Borders began in 2001 with what seemed like a reasonable business decision. Borders executives realized they needed some kind of online presence, but didn't want to invest the time, money, and expertise required to build a competitive e-commerce platform from scratch. Amazon, meanwhile, was looking for ways to monetize their superior logistics and technology infrastructure. The deal they struck seemed elegant. Amazon would handle all of Borders' online sales, from website design to order fulfillment to customer service, while Borders would receive a commission on each sale and maintain their brand presence. Borders customers who wanted to shop online would be redirected to a co-branded website that looked like Borders, but was actually powered entirely by Amazon's technology. For Borders, this seemed like the perfect solution. They could instantly compete online without massive upfront investment, while focusing on what they believed was their core strength: physical retail. For Amazon, this was an absolute goldmine. They were essentially being paid to acquire Borders customers, learn from their purchasing patterns, and gradually migrate those customers to Amazon's main platform. What Borders failed to understand was that they weren't just outsourcing their website, they were outsourcing their future. Every customer who bought a Borders book through the Amazon-powered website was actually creating an Amazon account, receiving Amazon's recommendation emails, and being exposed to Amazon's expanding product selection. Amazon's sophisticated algorithms were learning from Borders' customer data, becoming smarter about book recommendations while simultaneously introducing those same customers to Amazon's growing catalog of electronics, toys, and household goods. Even worse, Amazon's partnership with Borders gave them detailed insights into physical bookstore operations, customer preferences, and inventory management strategies. Borders was essentially paying Amazon to learn how to destroy them. The financial terms of the deal were heavily skewed in Amazon's favor. Borders received only a small commission on sales, typically around 10 to 15%, while Amazon kept the majority of the revenue and, more importantly, owned the customer relationship. When customers had problems with orders, they called Amazon. When they wanted to return items, they dealt with Amazon's customer service. When they received marketing emails, they came from Amazon. As the partnership continued year after year, the results became increasingly devastating for Borders. Amazon was using the steady revenue stream from Borders customers to fund massive expansion into new product categories and invest billions in logistics infrastructure, warehouses, and technology development. By 2005, Amazon had grown from a book-focused startup to a general merchandise retailer, while Borders remained trapped in their physical stores watching their online customers gradually migrate to Amazon's main platform. The data tells the story of this slow-motion corporate suicide. In 2001, when the partnership began, Amazon's annual revenue was roughly $3 billion, about the same as Borders. By 2007, Amazon's revenue had exploded to nearly $15 billion while Borders had barely grown at all, still hovering around $4 billion. Even more telling, Amazon's book sales alone were beginning to approach Borders' total revenue. The partnership had created a monster that was now devouring its creator. The 2007 launch of the Kindle represented the moment when Borders' strategic blunders became fatal wounds. Amazon had used years of book industry data, much of it gleaned from their Borders partnership, to develop an e-reader that would fundamentally transform how people consumed books. Borders, having spent a decade ignoring digital trends, was completely unprepared for the e-book revolution. They had no e-reader device, no digital book platform, and no direct relationships with the online customers who were most likely to adopt new technology. Their response to the Kindle launch was characteristic of their entire digital strategy: too little, too late, and poorly executed. Borders eventually partnered with multiple e-reader manufacturers, including Kobo and later their own Borders-branded device, but they were always playing catch-up in a market where Amazon had a massive first-mover advantage and existing customer relationships. By 2010, Amazon was selling millions of Kindles and digital books, while Borders was still trying to figure out what their ebook strategy should be. The numbers were brutal. Ebook sales were growing by over 100% annually, while physical book sales were declining, and Amazon controlled roughly 70% of the ebook market. Finally recognizing the mortal threat they had helped create, Borders terminated their partnership with Amazon in 2008 and launched their own e-commerce website. But this decision came 7 years too late and was executed with the same lack of vision that had characterized their entire digital strategy. Their new website was clunky, slow, and couldn't compete with Amazon's sophisticated recommendation engine, one-click ordering, and vast product selection. Worse, many of their former online customers had already migrated to Amazon's ecosystem and saw little reason to switch back. Borders also made the baffling decision to focus primarily on books and media, while Amazon was becoming an everything store. When customers wanted to buy a book and a coffee maker in the same order, they went to Amazon. When they wanted fast, reliable shipping, they went to Amazon. When they wanted detailed product reviews and recommendations, they went to Amazon. Borders had spent 7 crucial years training their customers to expect all of these things from their competitor. The company's financial situation was becoming desperate. They were carrying massive debt from their physical expansion during the early 2000s. Their same-store sales were declining year over year, and they were burning through cash trying to compete in digital markets where they had no expertise or competitive advantages. The final death spiral accelerated rapidly after 2008. Borders began closing underperforming stores, laying off employees, and desperately searching for buyers or investors willing to fund a turnaround. They sold their international operations, liquidated inventory, and even considered selling their customer database to raise cash. The irony was palpable. A company that had pioneered computerized inventory management in bookstores was being destroyed by a competitor who had perfected digital inventory management for the entire retail industry. In 2010, Borders posted a net loss of over $100 million on declining revenue of less than $3 billion. Their stock price, which had peaked at over $40 in 1998, was trading for less than 50 cents per share. Credit rating agencies downgraded Borders' debt to junk status, making it nearly impossible for them to secure the financing needed for inventory purchases during the crucial holiday selling season. Suppliers began demanding cash on delivery rather than extending normal payment terms, further straining the company's liquidity. On February 16, 2011, Borders Group filed for Chapter 11 bankruptcy protection, announcing plans to close nearly 200 stores immediately and attempt to reorganize around their remaining profitable locations. But the damage was too extensive and the competitive landscape too hostile for any meaningful recovery. Amazon's revenue had grown to over $34 billion, with book sales alone generating more revenue than Borders' entire operation. The bankruptcy process became a liquidation as potential buyers concluded that Borders' physical assets weren't valuable enough to justify taking on their operational challenges in a rapidly digitizing market. The final store closures began in July 2011, with desperate everything-must-go sales that drew crowds of bargain hunters but generated insufficient cash to pay creditors. On September 18, 2011, the last Borders bookstore turned off its lights forever, ending 40 years of operation and eliminating over 19,000 jobs. The company that had once been synonymous with book retail in America had been reduced to empty storefronts and clearance tables. The ultimate lesson of Borders' spectacular failure isn't just about technology disruption or e-commerce adoption. It's about the catastrophic consequences of outsourcing your core strategic capabilities to your primary competitor. Borders didn't just fail to adapt to the digital age, they actively funded their competitors' adaptation while remaining willfully blind to changing consumer behavior. They confused short-term cost savings with long-term strategic thinking, prioritizing immediate profits over customer relationships and market positioning. The partnership with Amazon wasn't just a bad business decision, it was corporate malpractice on a scale rarely seen in American business history. For a decade, Borders essentially operated as Amazon's unwitting sales force, training customers to expect online shopping experiences that only Amazon could provide while collecting minimal compensation for the privilege. By the time Borders executives realized they had signed their own death warrant, Amazon had grown into an unstoppable force that would eventually threaten not just bookstores, but the entire retail industry. Today, Amazon generates over $400 billion in annual revenue and controls nearly 40% of all e-commerce in the United States, built partially on the foundation of customer relationships and market insights that Borders voluntarily provided. The empty storefronts where Borders once operated serve as permanent monuments to one of the most avoidable corporate disasters in business history. A reminder that in the digital age, outsourcing your future is indistinguishable from surrendering it.